Welcome back to Media Week. Let's take a check on some of the news in the media space this week. And News Corp Australia has made an offer to purchase the parent company which owns and operates this channel, Sky News Business, and 18 other services. Australian News Channel is a joint venture of Nine Entertainment, Seven West Media and the UK's Sky. News Corp Australia made an offer yesterday to ANC's 3 shareholders. ANC already has a number of collaborations with News Corp Australian newspapers. Also to reporting season now, where most media companies have now laid bare their balance sheets for all to see. Investors welcoming Nine Entertainment's results as the company gets set to launch a $150 million share buyback plan. It comes as the company triples its net profit to $91 million for the first half, beating analyst expectations. It's also reaffirming guidance for full-year profit to grow by 10% as free-to-air TV ad revenues begin to pull out of the doldrums. Well, let's get more on this now and a wrap of the sector's results so far. We're joined by Evan Lucas from IG. Evan, great to have your company on the show today. Just let's kick it off with Nine Entertainment. What did you see as sort of the strengths and weaknesses in this result?
Yeah, it's probably an interesting one to have a look at. And Nine's a really good sort of overview of the entire sort of media space of where it's at the moment. It was a reasonable number. They do very much allude to the second half of this financial year being a little bit more tricky, that they will expect to see that the ad revenue actually slightly under a bit of pressure. And they do allude to the fact that in the first half they did see that. But as you already alluded to, free-to-air advertising was better than they expected. They now look at between 8 and 9% for the next quarter. They're also expecting that over the full year. They reiterated their guidance, which is also a fairly positive thing to see, considering that at the end of last year they got a really big kick from the Ashes. That was a real big point. The World Cup so far has not filtered through. So the numbers look good. EBITDA is expected to be $311 million. They expect underlying net profit around about $90 million, similar to what we just saw over the last sort of half. So good numbers, but again, there's a few little nicks and crannies in there that suggest that it will still be a tricky period indeed.
What about Southern Cross Media? Because on the day of the results, the shares were stronger, but the results weren't too solid. What did you take out of it?
No, they weren't solid, but the reason for the massive jump, and since they basically laid bare, as you said, their numbers, they've upped 15.5%. Now, the reason behind it, the biggest issue around Southern Cross was their debt levels and whether or not they were able to service them, and they are now very clearly showing that their caveats and their overlays with their covalence are going to be quite good. They look and want to get to a debt-to-earnings ratio of around about 2.5. At the close of their books at the half, they were at 3.1, so they're not far off that. Lending is also supposed to come down to 3.5. They are currently sitting at 3.7. So the market is championing more the fact that the biggest issue around them was debt. You did allude to the fact the results were certainly weaker than expected, but the outlook is a little bit more rosy. They're also showing the fact that even though they've lost Kyle and Jackie O, there is now becoming a bit of a turnaround story in that stock. So, like I said, the market has liked the fact that debt now looks in line, and they're now starting to see a bit of turnaround in their radio network as well. In terms of what we've seen in the media space, have there been many winners? I mean, what do the statistics look like for this? Yeah, dead even, and that's the interesting thing. So if you have a look at the media space as a whole, surprises to the upside on the sales line, 50-50. So 50% have actually beaten analyst expectation, the other 50 haven't. On the EPS line, unfortunately, it's a little bit weaker than that. It's only 45%. This is where it also gets interesting. If you look on an aggregate basis around the media space, on the sales line, it's actually declined just less than 3%, so 2.75%. On the EPS line, however, it is really, really lower, and that's not surprising considering the ad market where it is. And it's all down to publishing. It's declined 23%. Publishing had a really, really tough period, and that came pretty much out of Fairfax with those write-downs that we saw. They declined roughly around about 63%, and that's why across the board that 23% decline in EPS is there. So okay reporting season for the media space, but again, it's a tricky place to mitigate, and they're all saying the same thing. Very tricky ad space. Very much a fairly convoluted space to get revenue in. They are still coming to terms with online revenue and how print media still fits into that.
So in terms of themes going ahead, sort of still a struggling sort of outlook for that sector?
Yeah, it is unfortunate. And again, where the actual positiveness came from was actually media advertising, and that space incorporates the ones that everybody always talks about and champions, and that's the online space like REA Group, like Seek, like also car sales that do fall into that media space. They're the ones that really drove the numbers. They're the ones that actually saw sales growth, they saw EPS growth, and therefore their underlying net profits also grow at double-digit pace. So that's where the money's going to, that's where the ad dollars are going to, and that just comes back to what we've seen probably since around about FY 2012. If you have a look historically, publishing unfortunately has been consistently underperforming since that sort of halfway through 2012 to now, whereas media online advertising is certainly picking up.
What about dividends and buybacks? The buybacks seem to be a bit of a theme this year, with Nine being one of them.
Yeah, they certainly are. And I think that gets back to the Nine result that I probably didn't want to talk about at the start, because it's being skewed, and the real big upside that we're seeing in Nine is down to the fact that that $150 million share buyback just champions what we're seeing outside of the media space as well in that whole space. Have a look at what happened with Seven Group yesterday. They're engaging in another share buyback. Have a look at Rio Tinto as well with what they're doing, and they've all had very good earnings seasons on the back. At the moment, return of capital to shareholders is king. If you've done that, you've certainly had a very good earnings season. Strong dividends are also being rewarded. So the fact that Nine gave you a 4.2-cent dividend is also helping the share price as well. So in this market where risk and the risk-reward basis is being questioned, if you're actually showing that you're constantly giving money back to the shareholders, you've done quite well.
All right, Evan, as always, great to get your analysis. Thanks so much.
Thanks, Ingrid.
Evan Lucas there from IG. An outdoor advertising group, oOh!media, says it's seeing scope for expanding its digital content. It impressed shareholders with a narrower full-year loss than originally expected. Chief Executive Brendan Cook saying there's more room for growth when it comes to interactive digital billboards. Helen Daly spoke with him on those results.
Great result, obviously reflective of the sector and the growth that we're having in terms of engaging more customers for clients, and clearly represents a stronger than expected November, December, given the forecast was produced around October last year.
Yeah, so things obviously got very good very quickly.
Yeah, look, they did. I think a couple of things here. We've had a massive investment in product around digital signs and distribution of networks across a whole variety of areas in road and retail and fly and our place environments. And the consequence of that is that as the market started to shift, we found more clients increasing their expenditure. They wanted to really connect in location-based environments, and that all led to a stronger than we could expect November, December.
All right, so in general, what is the state of play in what you call out-of-home advertising? This is the advertising, as we're showing on the screen, that's on billboards, that's by the side of the road, that might be on some sort of a display in a shopping centre, might be in an airport. It appears a pretty healthy space.
Yeah, look, I think the simple fact is that, you know, advertisers are aware that our audiences are very stable or growing, and that technology is enabling us to deliver rather different ways to engage people, whether it might be to interaction with mobile devices or just day parting and time-sensitive information. And this is resulting in more opportunities for advertisers to try different things in the out-of-home space and deliver those growing audiences that we do have.
Well, it's interesting, if you know, just in the last little while, we know media companies in general have been having a very tough time of late, well, really in the last couple of years. We had a massive write-down by Seven West Media of its newspaper mastheads, but also some unhappy news there about the TV ad market. Why do you think your space, this outdoor advertising space you're talking about, is so different from the other ad spaces? You
know, the outdoor is the original media, and the strange thing is, in this world that's being totally disrupted, our product isn't being disrupted. You know, people are still spending more time out of home, driving on roads, going to shopping centres, catching planes, etc. And what we see is, because that audience is stable or growing, and the fact that we're now able to add products that are very creative in digital in particular, or other engagements with mobile devices and creative ways, the core values of the medium are being strengthened without the disruption that has occurred for other mediums. So it's really a fact that our audiences are stable, technology is our friend, we're not being disrupted, and we can deliver results for clients.
No, but how nimble and sort of digitally agile are you? I mean, in a sense, you're a disruptor, really, if you're talking about interactive advertising, things like that.
Well, an example was on Thursday night, the marketing director for Suncorp called us and asked could we get an ad up the next day in all over Queensland on our digital assets, promoting their helpline should anyone get hurt for the crisis that was going on with the cyclone.
Wow.
Now, that couldn't have occurred many years ago. We wouldn't have had the breadth and reach to do that, all the technology products. Today we do.
No, but I mean, sorry, just on that, example that you're talking about. I mean, couldn't they equally have called an ad agency to get an ad in the newspaper to do the same thing for the next day?
I'm sure they could have, and maybe they did. I haven't seen Friday's newspapers, but I think the end of the day is we know that unfortunately newspaper audiences have been decreasing, and the value is that that out of home can now deliver that same immediacy as newspapers, and with a big broad audience, and that's one of the benefits of the technology investment that we've been making.
Yeah. So just tell us. You said technology is your friend. Remind us about the sorts of products and just how far, I suppose, billboard and digital advertising has changed and has come.
Well, you know, recently in Victoria we had a campaign for Porsche where we were able to, by camera, read when Porsches were approaching the digital sign, and then send a personalised message to the Porsche driver, not as in knowing who they are, but knowing they were a Porsche driver.
Just say that again. That sounds quite extraordinary.
Well, look, you know, technology in terms of recognition technology is growing, and whilst we're a long way short of what we've seen in the movies with Tom Cruise in Minority Report, the reality is that technology is enabling you to read shapes and various things. So in this case, the shape of cars, and determine that we could push an ad that's 300 metres down the road on a digital sign to be a bit more personalised. So in this instance, it was really giving a personalised message to Porsche drivers. It could have been something else had it been another brand.
That's just extraordinary, isn't it? Now, are you actively looking at acquisitions?
Look, we've been an acquisitive company in history, and if something comes up, we will acquire them. We're not actively, because we have a massive capability within our own infrastructure to invest in, particularly the digitisation of major signs. We have the first, what I call Times Square site, going up in Australia in Melbourne. It's a 6-storey high, fully animated, full motion, high quality sign, right at Burke Street Mall. And that, those sorts of investments engage new ways that advertisers can reach growing communities, as well as the way we can do a whole range of new and different types of content creation.
Right.
So there's a lot of development around the product we existing have, but if opportunities did arise, then we would look at them. There's no question about that.
All right, and just very briefly, has life changed for you being a listed entity?
Not at this point, other than you know, a bit more media interviews when we do these announcements. But the reality is we've had a core plan for a while. We were listed previously, so it's really just a matter of getting on and delivering what we see as a strong business proposition over the next 5 years.
And in some company management moves, Pacific Magazines has today announced Darren Kerry as Head of Digital and Innovation. He joins the business from Southern Cross Austereo, where he led the digital design development product team. Pacific says it's undergoing a period of business transformation and a time of great change and opportunity. He plans to extend and deepen the audience engagement on all digital platforms, as well as realising the e-commerce opportunities going forward there. Well, that is all we have time for on this edition of Media Week. From the team here, thanks for your company.